Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points, highlighting the key learnings from the market activities in the past week. However, this week we'll put a key focus on the FOMC meeting and the decision to cut rates by 50 basis points. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll talk about the rationale behind the rate cut. In point number 3, we'll talk about the Fed's dual mandate. And in point number 4, we'll talk about the disinversion of the bond yield curve. The Federal Reserve's interest rate decisions remain a focal point for markets. While the timing and size of rate cuts are subject of debate, why the central bank is cutting rates and how the full rate cut cycle may play out are far more important. This is because the implications are not as straightforward as they might seem, and market expectations have shifted dramatically over the past year. So, what should investors know about how rate cuts have historically impacted the economy and markets? Well, we'll explore that today. But before we do that, let's go on to point number 1. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a healthy 2.9% growth as of September 18th, which is up from the previous estimate of 2.5%. Next, each week we take a look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, the initial claims came in at 219,000, which is a decrease of 5.02% from last week, and continuing claims also fell by 1.12% to 1.829 million, a decrease of 21,000. This is great to see with the latest initial claims data falling below our year-to-date average, and it's the lowest we've seen in the past 4 months. Next, for 2024, we are watching mortgage rates closely to see how home affordability is trending. In the upcoming weeks, we'll talk in more detail how affordability is calculated and show some data to further define this picture. This week, we'll keep the focus on mortgage rates. This week's rates fell further with the 30-year and 15-year ending at 6.09% and 5.15% respectively. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread jumping from 8.84% last week to 24.42% this week. This is an increase of 15.58% from last week. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is showing a 51% probability of a 0.5% rate cut and a 49% probability of a 0.25% rate cut in November. Since we recently had a 50 basis point decrease and we are nearly 2 months away from the next FOMC meeting, I wouldn't put too much weight in this data. I anticipate this to change multiple times before that meeting. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 1.24%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was positive 1.78%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was positive 0.25%. Aggressive stocks took the win. That's 2 weeks in a row. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week, we have a new leader. Appropriate diversification not only decreases your risk, but it also exposes you to the positive upside. So, if you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. And now on to point number 2, the rationale behind the rate cut. The Fed typically lowers interest rates in response to a weakening economy, since doing so makes it cheaper for individuals and companies to borrow, while also increasing the incentive to spend rather than save. In theory, this boosts growth and supports the financial system, especially during recessions and financial crises. Over the past few decades, the Fed made dramatic cuts during the early 2000s dot-com bust, the 2008 global financial crisis, and the pandemic in 2020. Now, how the economy and markets typically behave during the rate cut cycles can be easily misunderstood from these historical episodes. While lowering rates is intended to promote growth, doing so during an economic crash means that a recession and bear market are likely to follow, and the last several quarters after that first cut. This means that rate cuts are historically correlated with poor market returns, even though it's clear that rate cuts were in response to, rather than the cause of, these challenges. Conversely, while rate hikes are typically seen as slowing the economy, they often occur during economic booms and bull markets, as the Fed slowly pumps the brakes. Thus, counterintuitively, rate hikes have historically corresponded to strong returns in the market. Today, the Fed is not battling a sudden economic collapse or financial crisis, but instead is navigating a period of steady but slowing growth with improving inflation and a weakening but still strong labor market. In other words, this is something I really want to highlight, that the current situation is quite different from periods of the emergency rate cuts. This is why the rationale for lowering rates matters when considering how they might impact markets in the years and months ahead. Now, perhaps a more applicable example is the 1994 to 96 rate cut cycle, where the Fed raised rates to combat inflation fears before lowering them shortly after. Periods like these are often referred to as a soft landing, since the Fed arguably managed to cool the economy without triggering a recession. While there was significant shock in the bond market, just as there was in 2022, markets eventually responded positively to rate cuts once the economy stabilized. And now on to point number 3, the Fed's dual mandate. The Federal Reserve's dual mandate, as described in the 1977 Federal Reserve Act, is, and I quote, to promote maximum employment and stable prices. Today, this is interpreted as returning inflation to 2% while ensuring the economy continues to grow steadily. These objectives can be in conflict, since faster growth should, in theory, result in higher inflation. From 2009 to early 2020, inflation was nearly non-existent, allowing the Fed to keep interest rates exceptionally low, resulting in one of the strongest labor markets in history. In contrast, the inflation of the past few years has required the Fed to make tough decisions between price stability and jobs. Fortunately, inflation has been improving since its peak in 2022. The latest CPI, or Consumer Price Index report, showed that prices continued their gradual descent in August, with the headline index rising only 2.5% year over year. However, the Fed is hesitant to declare victory since core CPI, which excludes volatile food and energy prices, experienced a slight uptick to 3.2%. This was primarily due to the stickiness in the housing market, which has been a point of concern and why we've been tracking home affordability in our weekly videos. It's been said that monetary policy works with long and variable legs. In other words, if the Fed waits for inflation to be all the way back down to 2%, it may have waited too long. The cost of doing so would be over-tightening of the job market, which could have real-world consequences on households and businesses. Thus, the recent softening of the employment data provides further support of reducing rates. And now, point number 4, the disinversion of the inverted bond yield curve. Given these economic trends, most economists and investors feel that the Fed will cut rates a few times this year and throughout 2025. Bond yields have responded with the yield curve disinverting for the first time since the rate hike cycle began in 2022. This is because short-term interest rates, which are tied up to the Fed policy, have begun to fall, while long-term interest rates, which are tied to economic growth, have not declined as much. This results in an upward sloping yield curve, which is often seen as positive for the economy. While the past is no guarantee of the future, lower rates have been positive for both stocks and bonds across history. Bond prices in particular move in the opposite direction of bond yields, which is why many bond indices have rebounded in recent weeks. For stocks, lower interest rates mean that businesses have access to cheaper financing for investment and expansion. When it comes to the math of valuing companies, lower rates means that future cash flows are discounted less, which can result in more attractive prices today. Of course, the market never moves up in a straight line, and investors should always be prepared for periods of volatility as the financial system adjusts to the Fed moves. As we enter a new phase of monetary policy, economists and all of us will be very closely monitoring these indicators, particularly those related to employment and growth. The Fed's challenge will be to calibrate its policy in response to support, the Fed's challenge will be to calibrate its policy to support the economy without reigniting inflationary pressures or creating imbalances in the financial markets. Now, the bottom line. Understanding why the Fed is cutting rates is as important as the policy moves themselves. Rather than focus on individual rate cuts, investors should maintain a long-term perspective to stay on track to your financial goals. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button below, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Once again, thank you for watching. We look forward to seeing you next week.